Hi, my name is Toxie. I'm the president of Evergreen Anchor Capital. Welcome to another episode in our series titled My Not So Crazy Mortgage, aimed at getting you prepared before you apply for your next mortgage loan. The information we provide in this series will help you get better mortgage loan options, better interest rates, and a better experience in the mortgage process itself. Today, we'll be answering the question on what is the debt to income ratio? The debt to income ratio is the first step in how your bank or loan officer calculates how much of a loan you can get. It actually calculates how much of a mortgage payment you can afford, which then conversely we use to calculate how much of a total loan will be given to you to purchase your home. Debt to income, as it states there, is what your debt is in relation to your income. What that percentage is, there's a limit on that percentage that you're allowed to have when you're qualifying for a particular loan. So it's not just how much you make, it's not just your income that allows you to qualify for a certain amount. It has to be in relation to the debt that you have as well. And that's why you could have two people making the exact same amount of money, but qualifying for different mortgage amounts. One could qualify for, 200,000 while the other one qualifies for just 100,000, and yet they make exactly the same amount of money. The debt to income ratio is a percentage that typically ranges from about 38% to 55% depending on the type of loan. That range is because different loans have different DTI ratio requirements. Some are 38, some are 43, some are 45, some are 50, 55. There are a few that are above the 55, like I mentioned, but those are rare cases. And remember, this whole series is helping you get prepared so that you have the most flexible options available to you. If you qualify for all the different types of loans that have all the different DTI requirements, then you can pick whichever one you want. But if you're not prepared and say you come in and all you qualify for is a loan that has a 40% or 38% or 43% DTI, well, then that's all you'll be stuck with. Now, when we say 43 or 50%, or when we state those numbers, what it means simply is this: your monthly liabilities and your new mortgage payment combined cannot be more than whatever that percentage is of your income. So let's use 50%. Just to make things easy, we'll use 50% as our DTI requirement. Say we have a loan and the DTI requirement for you to qualify on this loan is 50%. Again, it means your current monthly liabilities plus your new mortgage loan combined cannot be more than 50% of your income. So let me break that down. Your income is basically your monthly income is what we're using here. Because people earn income in different ways and people get paid differently, the way we calculate income is we take your year's income and we divide that by 12. So it doesn't matter if you're paid bi-weekly, every month, or whatever. We add that all up together and we divide that by 12, and we get your monthly income. That monthly income in this example where we're using 50% is what we take. So let's put some real numbers to it. Let's say you make $5,000 a month. You make $60,000 a year, $5,000 a month. 50% of that is $2,500. So a DTI requirement means that all your existing liabilities and your new mortgage combined cannot be more than $2,500. So what are those liabilities you speak of, you ask? Well, those liabilities are just things that are listed on your credit report. Okay, when we pull your credit, which is one of the reasons why your bank has to pull your credit when they're trying to pre-approve you, is the items listed on the credit report, the trade lines there are what we use and count as liabilities, not your rent bills, not your utilities, not your phone bills and things like that. Those are not counted. It's just the trade lines that are listed on your credit report, which is why it's important that you know what's on your credit report before you apply for a mortgage. So make sure you check out our video on credit reports. But yes, it's just the trade lines that are listed there. And on those trade lines, it's not how much you owe in total. It's just the monthly payments that are listed on those trade lines. So the bank doesn't care how much you owe. You could have a car that's worth, $200,000. It doesn't matter if that's what you owe on the car. But if the monthly payment on that car is $200, $200 is all we count, because we're looking at monthly income versus monthly debt, monthly liabilities. So we pull your credit report and it's just the trade lines that are listed there. Those are the liabilities. We add those payments together to get your total liabilities that are existing. Now, if you've got collections on there, we take all your non-medical collections that are over $2,000. Current regulations state that we will apply a 5% payment to them. So, $2,500, 5% of that is $125. We'll apply a $125 payment to your current liabilities. We add all these liabilities together, and in our previous example with the $2,500, we subtract that from the $2,500, and whatever is left is what we can use as a mortgage payment for you. Because remember, your liabilities plus your new mortgage cannot be more than 50% of your total monthly income in this example. Because again, the DTI, or debt to income ratio, that we're using, this loan that we're using the example for, has a 50% debt to income ratio. So sticking with this example, we said this person makes $60,000 a year, so $5,000 a month. We're applying for a loan that has a 50% debt to income ratio requirement, or DTI requirement. We take that $5,000 and 50% of that is $2,500. Then we've looked at the person's credit report and we've added up all their trade lines to see what their monthly debt is. So let's say in this example, the person's debts all add up to $1,000. That's what they pay out monthly in terms of a car note, credit cards, student loans, whatever they have. It totals $1,000. If you subtract that from the $2,500, we're left with $1,500. That means you can qualify, or this person can qualify, for a $1,500 mortgage payment. And based off of a $1,500 mortgage payment is how we calculate how much of a total loan that they can get. Now, you'd want to look at our video that talks about what goes into a mortgage payment, because it does vary. $1,500 will get you a house of a different price, depending on what area you are in, depending on what type of house you're getting. And that's why I don't just want to throw out a number and say, $1,500 will get you a house of this price. No, there are some differences there. It's not always exact. So check out that video and that will explain that further. But this is the first step. We look at how much you can qualify for a mortgage. So in this case, this example, the person qualifies for $1,500. Using this same example, let's say there's someone else that makes the exact same amount of money, also makes $60,000 a year, but this person has just $200 in liabilities on their credit report. That means $2,500 minus $200 is $2,300. Now this person has room for a mortgage payment of $2,300. I'm not saying you have to have a mortgage up to $2,300, but you have that choice. You have that option to go all the way that high. Now, obviously, this person can borrow a lot more than the person who can borrow only $1,500, who has only $1,500 left over. And that's again why you can have two people with the exact same income, but because of the difference in liabilities, they're able to borrow way different amounts when it comes to purchasing, a home. If you fall into the category where you're not able to get as much as you want, sometimes one of the easiest ways in order to be able to borrow more is to bring down your debts. Because if your income is typically fixed, it's the debt that we have, and you can pay down debt in order to be able to have a larger mortgage payment, which in turn reflects into a larger amount that you can borrow for the house. So that, in very simple terms, is what the debt to income ratio is. Your loan officer or bank is the one who's going to actually do all those calculations for you. This video is not to put you in place of them. It's just for you to understand what's going on, and you can do a few calculations yourself. If you know, because a lot of people come and they know that they want to have a mortgage payment not more than a certain amount. It could be $1,500, it could be $2,000, $2,500, whatever that number is that you feel you're comfortable with. At least with the simple calculations that we did here, you would know if you would even qualify for that amount. Also, if you look and you've got a lot of liabilities, you know, before you apply for a mortgage, it might be a good idea to see which ones you could get rid of. But as always, talk to your mortgage banker and explain the whole situation to them. Let them tell you, you know, don't just go ahead and start paying things off before you talk to them, because sometimes there are things that can be done. Sometimes you don't need to. But go ahead and talk with them. But at least now you have an understanding of what the debt to income ratio stands for, because guaranteed your mortgage banker is going to be talking to you quite a bit, you know, about that. So check out our video on what goes into a mortgage payment, because that kind of goes hand in hand with this particular video. And you know, please like the video below. Also subscribe so that you can see when we release other videos, and leave your comments. Let us know what you think, or if there's any further explanation you'd like us to make on this topic, we'd be happy to do so. Until the next video, please continue to do what it takes to get prepared for that fantastic mortgage.